Hi, everyone. Welcome back. And this section is 13.6. This is the last section of the semester, so you have made it this far. Income tax liability. What are we going to do in this section? Well, we're going to talk about income tax liabilities. We're going to look at capital gain on taxes and stock sales, capital gains on the sales of your home. What is the income tax liability? So taxation in the United States and in many other countries is structured in a progressive manner, meaning that the higher income earners pays a higher percentage of their income towards taxes. So table 17, which is found on your modules, shows the federal income tax brackets for the 2022 tax year. The government allows deductions for incomes that is allocated to mortgage interest, charitable giving, tax-deferred investments, and various other purposes. So after these amounts are deducted from gross income, that is what remains as a taxable income. So the table 17 is an example of the 2022 brackets for those where it shows the deductions. So notice that we talked about tax-deferred investments like retirement plans or other purposes that are allocated from deductions. So after these amounts are deducted from the gross income, what remains is taxable income. These are an example of income brackets. So these are the tax rates. This is for a single home, for married jointly, or taxable income of household. So it depends how much you make. So they're going to be charging you 10% if you're making anywhere between 0 to 10,000, 0 to 20. See, the more percent is the more you make. So if you're making, let's say, for example, if you're married jointly, like you and your couple, and you're married and you're making anywhere between 20,000 to 83,000, they're going to charge you a 12% tax rate. If you're 22, if you are anywhere between 23 and 178, or if you're head of the household, like if you're a single person, or you're separated or divorced, but you're head of the household, and this is how much you're making. So let's say like you're married and your wife or your husband doesn't work, then you're the head of the household. Or if you're a single, like if you're not married and you are only working on your own and this is how much you're making, that's how much they're charging. So the more you make, the more they charge. So the Momberlays have 123,000 in taxable income for the year of 2022, and they will be filing jointly. So they live in a state with a 4.7 flat income tax, determine their combined federal and state tax. So for that one, we have to look at the different brackets. So let's look at the first one. Well, we have their taxable income. So this is the income, 123,000. They put them at 22%. So let's go back to our table. It said they're going to fill it jointly, and it's 123,000. So it's going to be this bracket. 123,000 is here. That means it's 22%. So what we're going to do is we know it's going to be 22% from the federal tax. This means 3 different tax applied to their portion. So the first one is 20,550. It has a 10% rate. Anywhere between 83 to 20, the 63,000, it's a 12% rate. Anywhere between 123 minus 83,000 is 39,550 at a 22% rate, because we're looking at a 4.7 flax rate. So therefore, the federal income tax liability is you're going to do 10% of the 20,000. So see how they begin with the 20,000, then the 83,000, and then the 178 here. So here we have 10% of this amount, 12% of this amount, 22% of the rest amount. So we start with 20,500, that's the 10%. The 83 minus the 20, that's 63,000. It's going to be 12% of that. And the 123, which is how much they make, minus the 83,000, it's 39,000. So when we combine those together, 0.10 times the 20,550, 0.12 of the 63,000, and 0.22 of the 39,450 gives you a federal income tax of 18,294. Now the state is already telling you that the state is 4.7. So it's 4.7. So when we change 4.7, 2 decimals to the left is 0.047 times the amount. It's going to be 5,781. Combined, Morbley's combined income tax liability is 18,294 plus 5,781. That gives you a total of $24,075. So when you're doing the federal, that's when it goes in brackets. The first bracket is anywhere between 20,500, and I'm looking at the jointly because they're going to do it jointly. If this was a single, then that would be something different. But I'm doing it jointly. So there it is, the 20,000, and then I subtract 83 minus this, and then I'm going to get a value, and then I'm going to subtract the 123,000 minus the 83,000, which is going to give me the 39,000, which are the different brackets of the federal income tax. So federal income tax will consist of the different percentages until you get to your 123,000, whereas your state liability, if it's a flat rate, it's just going to be the rate times of the state income liability. Capital gains. So most taxpayers earn income in form of a salary, wages, tips, or self-employment income. Another common source of income is capital gain. When an asset is held for less than 1 year before it's sold, then the profit from the sale is considered a short-term capital gain. It is taxable at the same rate as a normal income if an asset is held for more than 1 year before being sold. Then the profit from the sale is classified as a long-term. So there's 2 types. There's a long-term sale, a long-term capital gain. If it's for more than 1 year, and if it's less than that, if it's before than 1 year, it's a short term. And it's also taxed at a lower rate than a regular income, depending on the income level. A long-term capital rates gains in the 2022 years are shown in Table 18, and Table 18 and 17 are both shown in your modules. So here we have an example. There's capital gain taxes. So these are the taxable income for single, the taxable income for married, the taxable income for head of the household. These are the rates. Depending on if you have a 0% rate of 15, it depends on how much you make. Are you making anywhere between 0 to 41,000, 0 to 83,000, 83 to 517? So this is how much you're going to be getting taxed from capital gains. Okay. So this table is given. Now, we wish to determine the tax liability with stock sales. So Rain now will be filing a single, there's a single, and expects to have a taxable income of 85,000. So let's look at the a single, 85,000. So we're looking at a 15%. At the end of the year, he purchased a stock for 11 months ago, and it's considering selling for 40,000 worth of stock, which is 4,000 for profit, to make a down payment on a house. Find Reynolds' federal income tax liability under the following circumstances. If he sells the stock now at the 11th month, versus he waits another month, so that's going to be 2 different values. So it's either a short or a long-term stock. So if Reynolds sells the stock now, the profit from the sale would be considered short-term capital gain. So then that would be taxed at a normal rate, and his income would be 85,000. This is how much he makes annually, plus the 4,000, because that's how much he's gonna get from the stock, 4,000 to his profit. That would be 89,000. So 89,000, if we go back, 89,000. And we're looking at taxable income for single, taxable income married or filling. So we're looking at anywhere between 41,000. So these are the capital gains. So he wouldn't have, so if we're looking at how much he's gonna make, he has 89,000. So let's go back to the first federal, because we're looking at the federal up here, federal. So he's gonna make $89,000. So that's gonna be, again, 22%. So we're gonna look at 0.10 times this 10,275, plus then you're gonna do the subtraction, right? So you're gonna start with the 10,275, then you're gonna do the subtraction between 41,775. So the second bracket. So this is the first bracket. Again, this is from the federal. First bracket, second bracket, and third bracket. So the same way we did it for the first example. So he would just add it, because this would be a short-term capital. It will have a federal income tax liability of 0.10 times your 10,000, 12% times your 31,500, 22% times your 47,000, because that's how much he made. So that should be a tax liability of 15,197. We would look at this one if we have a long-term capital gain, but we don't. We have a short gain, so we have to look at the federal. So this is the federal, and he's filling single. He's a single filler, and he's made $89,000. Okay. Now let's look at the next example. Now, if he waits another month, now that's going to be considered as a long term. Now, according to table 18, the taxable income of $89,000, he will make, again, $4,000. Now he's going to look at a tax of 15%, because that's when we're looking at over here. A long term. This is this percent, because he's going to make $89,000. Now this is for a long term. A long term. Because he waited for another month. So now you're going to look at your federal, and he's going to have, well, the same amount. He's going to look at his federal. But now the difference is he's going to even add even more, because you're looking at now the long-term capital gain. So the long-term, you're going to get your $4,000 times the 15% rate. So your federal income tax liability will, so here it was 0.10, 0.12, and 0.22. So here we had our 89,000, but see how instead of being 89,000, it becomes 85,000. That's the big difference. So look over here. So before this was 10,000, this stayed the same, this stayed the same, this one changed, because you're getting 4,000 from those. So it's 85 plus 4,000, that's your 89. So here, this is the same amount. The difference is here. The 0.22, it's only going to be 43,225 plus 15% of the 4,000. That going to give me a total of 14,917. When you're selling a home, a capital gains are realized whenever an asset is sold for more than its purchase price. This applies to a sell home with some special allowances. So for example, if the interest are increasing, the house prices are increasing. Since passage of taxpayers' relief of 1997, taxpayers are selling a home can be exempted up to 250,000 capital gains, filling up a single, up to 500,000 if married or jointly, as long as the home was your primary residence for 2 out of the last 5 years. The capital gains are determined by subtracting the cost basis of the home plus the capital improvement of the home. So then, if we wish to find how much profit you're going to be making of a tax liability of a home, we're going to use the price of capital gains by subtracting the cost basis. So the Westbrooks bought their home in 2008. This is how much they cost, $440,000. They spent $150,000 on home improvements, and they sold their house for $1,200,000. Their taxable account, including capital gains, are from the sale for 2022 was $274,000. How much did the Westbrook pay in capital gains tax on their home? Well, first, you have to look at the purchase price plus capital improvement. So the total gains or the cost basis, how much they invested in the house was $590,000. Now we have to subtract that, right, from how much they had. So the capital gain is the sale price minus the cost basis. So the sale price was $1,200,000 minus $590,000. It's $610,000. So this would be the capital gain, but because the Westbrooks have owned and lived 2 out of the 5 years, they qualify for the $500,000 exclusion from capital gain. So again, we're looking at the taxable here. Taxable liability. So it's going to be the capital gain minus the inclusion. So you're going to look at the net cap, not just the capital gain, but the net. So the net is removing your capital gain minus the exclusion from the table, $500,000, because that's how much it was said it will be. The cost basis, they qualify for $500,000. So they would have $110,000. Now the taxable is different. So you have a taxable income, which was given $274,000 plus the net capital. That would become the total taxable income. Write this formula down. The taxable income plus the net capital is equal to the total taxable income. So again, in your table 18, looking at the amount of $384,000, it will fall under the 15%. So now the last part is to look at the capital gains on the sale of their home. So it's going to be 0.15, so 15% of the net gain, the net capital gain, which is $16,500. And that will be how much it will be for their own. But this is the total taxable income. Oops. And then there's the capital tax gains of the sale of that house, 16,500. So it is a lot of formulas going back and forth between table 18, table 17. They will be placed on your modules. Okay. Thank you. And I will see you guys next time. Good luck. Let me know if you have any questions. Happy to support. Have a wonderful day. Bye.